All right, everyone. Hello and good evening. Welcome to our monthly webinar. My name is Justin Cooper. I'm a hard money lender, full-time real estate investor, and coach and consultant. Each month, we bring in some of our friends in the industry to share their expertise. This may be through a presentation, like when we talk about self-directed IRAs or title insurance, or we may simply interview our expert friends and dive deep into how they got started, where their investing has taken them, and what they see coming both for themselves and for the industry. We may or may not record each event, so it is important that you register and sign in early so you don't miss anything. Of course, everybody listening has already done so. You will also have the opportunity to ask us questions live on the webinar, and we do our best to answer each and every question. We will be doing that in the questions section tonight. Now, I also want to say thank you to everyone who made it to tonight's event. We know that you're giving up some of your time, so Joe and I will do everything we can to bring you the value that you're hoping for. Now, this webinar is brought to you by Pine Financial Group. Pine Financial is Colorado and Minnesota's premier hard money lender. Pine focuses on the needs of Colorado and Minnesota real estate investors. We're investors ourselves, and we know what it takes to get deals closed. Everyone at Pine Financial Group is dedicated to the success of its clients. We only experience success when our clients are succeeding. So we have a habit of telling you when a deal should or should not be done. And isn't that what you want from a professional in the industry, especially someone that you trust as an advisor? You will benefit from our honesty and integrity when you choose to work with us. Now, we do have one upcoming event I want to make sure you have on your calendars. We have our Real Estate Investor Success Summit coming up next weekend in Denver, Saturday, October 12th. So this is an all-day amazing educational and networking event. If you're in Denver, if you're in Colorado, I would highly encourage you to come to it. You can learn more about the speakers and what we have going on at our website, denveriss.com. That's also where you can go to register. So again, the Real Estate Investor Success Summit is coming up Saturday, October 12th in Denver, and you can register and learn more about it at denveriss.com. Now tonight, I feel very lucky and privileged to have my good friend Joe Massey with Castle and Cooke joining us. He recently put together a brand new presentation called the ROI Quadrant. Cash flow is not everything. And I'm really excited to see this presentation and to be sharing it with all of our attendees tonight. So Joe, tell us a little bit about you, and then let's dive in and learn about the presentation.
Absolutely. Hey, thanks so much for having me, Justin. Really appreciate it. Always enjoy these events. Really looking forward to the Investor Success Summit coming up next week as well. I think that's going to be a great event. For anybody that has not been to that, definitely make time in your schedule to go check it out. It's going to be a ton of good information. I know it goes from 8 or 8:30 in the morning on Saturday until 4:30 or 5 in the afternoon. I learn something every single time when we go to that event. I've been to that event, gosh, 12, 13, 14 times now, and always learn something. So definitely make time in your schedule to go to that. And again, my name is Joe Massey. Castle and Cooke Mortgage have been in lending since 2002, and been in mortgage finance for, gosh, what is that now, 17 years, which kind of makes me a dinosaur in the industry. A lot of mortgage lenders are in and out of the industry relatively quickly. So my background, again, in mortgage lending has been fairly extensive and been really good with investors. We do a lot with investors. Currently here in the Denver market, do a lot of transactions with Pine Financial and the guys over there. Been working with Justin and Pine for, I think, 8 years now, 8 or 9 years that we've worked together.
Yeah.
And really excited to talk about this evening, the return on investment quadrant. This is something that, every real estate investor has always gotten, but I think now we've got a way to measure it. And when I say it's something you've always gotten, it's a return that you've always been receiving, but it was always more difficult to measure than we have right now. So let's jump in and kind of get started here. And Justin, you said everybody can see my screen, is that right?
Yes, we can. And I see that little red dot you're moving around as well.
Little icon there. All right, why is my PowerPoint not going here? Oh, there we go. Do I have to? I'm not very smart with my technology, so there we go. Okay, now I got it.
Got it.
So first disclaimer here, obviously, guys, I'm not an attorney. I am not a CPA. I'm a mortgage lender. Justin is a hard money lender. You need to understand investing in real estate does come with risks. You need to make sure you've got the appropriate CPA, the appropriate attorney, the appropriate professionals, in order for you to have the right advice and make sure you're investing in the right realms for long-term or short-term investments. So your results might vary, but just don't forget, we're here to talk about real transactions and how you can succeed. But Neither one of us are attorneys. So who are we? I put this presentation together with Chris Lopez. He's not here with us this evening, but he is a investor and real estate agent here at York Castle Real Estate. He does a lot with house hacking, rental properties, and real estate financial planning. And then, of course, I introduced myself already, Joe Massey, Castle and Cooke Mortgage. So Chris is not on the webinar, but he and I put this presentation together to put this together as a team. And what we're going to talk about today is the return on investment quadrant. So what is your return on investment? For years, we always focused just on cash flow. We would buy a property and, hey, it's cash flowing $500 a month. Oh man, that's a great deal. Okay, cool. Well, as the market has gotten more expensive in Denver, we're seeing that it's more difficult to get great cash flow, but we're still seeing people make a lot of money in real estate. And so we got to thinking about it. What are all of the benefits that you get when you own property? Well, you get the value of the property going up, you pay down the loan, you get tax benefits, you get cash flow, you get all of these ancillary benefits, which might not necessarily be cash right now, but they're benefits over the long term. So even as properties become more expensive, these benefits are still there. And they break down to that cash flow, appreciation, debt reduction, so the debt being paid down, and then tax benefits. And combine all of these and you're going to get that return on investment. So for so long, we were focused solely on cash flow. We were still achieving these results, but we weren't really measuring it. And that's what this ROI quadrant does. It allows you to measure these results. So we're going to start by talking about appreciation. So appreciation is speculative. This is, maybe it's going to go up, maybe it's going to go down. In the Denver market, properties have appreciated on average 6% for the last 40 years. Now, some years were 3%, some years were negative 5%. Really just depends. But over the long term, it's been roughly 6% in the Denver metro area and 3% nationally. So that 3% national, really similar to inflation. But here in Denver, we actually outpace inflation and have outpaced inflation for the last 40 years. Again, keeping in mind, there are some ups and downs. Some months some years it's better, some years it's worse, but average 6% year over year.
And Joe, don't forget that we do have a national audience on the call. So I really appreciate the
Oh,
fact
that's
that,
true.
one, you are here in Denver. And so, of course, you can speak much more educatedly about what's going on here in Denver and Colorado. But I love that you also put in what's going on nationally because we do have a national audience. And so really, we're going to speak probably a little bit more to Denver just because that's where you are and
Yeah,
when you were top of mind putting this together. But I mean, a lot of the stuff is just as unique as we all think Denver is, it's also not that different from the rest of the country. So
it's really not.
anytime Denver, Joe says Denver, it will most likely still apply across the board and across the country.
Absolutely. What a great reminder, too. I always forget these webinars. We have people from all over the place. I'm so accustomed to doing this in person and everybody's, 20 minutes away. So that brings up a great question. What's the correct appreciation rate to use? So maybe you're not in Denver and this 6% doesn't apply to you. Maybe you're in, I don't know, Omaha, Nebraska. Well, go into your local Denver Association of Realtors and you can find, or your local association of realtors, and you can find that stat. There's going to be folks there at the realtor board that's going to have this breakdown of what has the appreciation been for a long period of time in your market. Maybe it's not 3%, maybe it's 5, maybe it's 4, maybe it's whatever, 7, depending on your market. So you want to make sure you're plugging that in. Now, it's important to, again, remember that is speculative, might be different next year, but over the long term, that's what it's historically been. I like to believe that's what it's going to continue to be over the long term. All right, let's talk about cash flow. Again, speculative. And a lot of people say, well, how's it speculative? I know that I can rent this property for $1,500 a month. Well, that's true if you get a tenant in there. But Justin, let me ask you a question. You ever had a tenant move out unexpectedly?
That has happened.
Yeah, you ever had a property that you thought rents were going to be, I don't know, 1,500 or 2,000 and ended up being 12 or 1,300?
Sometimes that also happens.
Yeah, so it is speculative. So it's not a guarantee. And the way we calculate cash flow on a simple basis is your rent minus your expenses, minus your mortgage payment. That is going to be your cash flow before taxes. So pretty simple way to look at it. And you can improve this by putting more money down. So a quick way that you can think about this is if I pay cash for a property, I put 100% down, I'm not going to have a mortgage payment, which is my largest expense. Therefore, I'm going to have my strongest cash flow. dollar-wise. However, maybe I put, I don't know, 15% down or 20 or 25% down. I'm going to have a little bit of a bigger mortgage payment. My cash flow might not be as great on a dollar percentage or on a dollar basis, but maybe I'm making more on a percentage basis. And we're going to compare a couple of those scenarios. Oops, went too fast. So cash flow is usually pretty easy to understand, and it's what a lot of people focus on because it is today's dollars. It's easy to see this cash flow going into the bank. This appreciation may not be as easy to see because it's not liquid. All right, let's talk about debt reduction. This is as close to guaranteed as you can get without actually being guaranteed. Now, what I mean by that is if you make the monthly payment, you're going to get this return on your investment. And when I say guaranteed, I would assume that by buying this property, you're planning to pay the mortgage every single month. If not, that's maybe an investment strategy that we should work on. So I definitely think that this debt reduction, if you're taking out a mortgage, paying this payment every month and paying down that principal, darn near a guaranteed return. Now it is going to vary depending on the length of the loan. So if I have a 30-year loan, I'm going to be reducing that debt less in the beginning years and reducing that debt more in the later years. Now maybe I have a 15-year loan. I'm going to be reducing that debt more in the beginning compared to a 30-year, and then really reducing it a lot in year 15 compared to a 30-year. But in the short term, it's going to vary by interest rate, but in the long term, the interest rate doesn't matter because this debt reduction, if I take out a $100,000 loan at 4%, I'm still going to pay $100,000 down on the debt. If I take out a $100,000 loan at 8%, I'm still going to pay $100,000 down on that debt. So I'm going to get my same return for this quadrant regardless of my interest rate. Keeping in mind, my interest rate may impact my cash flow quadrant, but my interest rate is not going to impact my appreciation quadrant or my tax benefit quadrant. All right, so debt pay down is one of my favorites that I think we often overlook. Justin, I'm going to put you on the spot. If I buy a property and I take out a mortgage and I'm paying down that debt, who's actually paying that down? Am I doing that?
Well, if it's a rental property, that would be your tenant, as your
That's
tenant
exactly
is
right.
making the payments, basically.
That's exactly right. The tenant is paying down that debt, which is why we measure that as a return, because it's not debt that I am paying down out of my pocket. The tenant is paying it. Okay. The next one we have is tax benefits. Oh, pardon me, almost forgot. The debt reduction, that benefit goes away once the loan is paid off. All right, so if I pay this debt down very quickly, I'm going to lose that return on my investment right away, but some of my other investments are going to get better. My other quadrants are going to get better because I'm going to have more cash flow once that monthly payment is eliminated. So let's look at tax benefits. This is one that I think we do not measure nearly enough. And this is based on tax law, which is pretty darn certain as long as there are no tax law changes. And depreciation has been around since the early 1980s is when it was written into the IRS tax code. I don't see that it's going to change anytime soon. I have been wrong before, but I feel pretty darn certain that this is going to be consistent for a long time, certainly over my career as an investor. And you're going to view this as raw dollars or as an after-tax benefit. And I'll show you guys we're going to do this as an after-tax benefit. But the way it works is the raw dollars is the total depreciation from the property, not factoring in the investor's tax rate. Well, the
And
spreadsheet,
so
oh, sorry.
can you just tell us what depreciation is?
Yeah, so depreciation is if I purchase a property and let's just say I pay $100,000 for it, generally 15% of that is the cost of the land on average, sometimes more, sometimes less, and 85% of that is the cost of the structure. You can depreciate that because that structure is going to have wear and tear on it, and for under the IRS tax law, they allow me to take a non-cash deduction for the depreciation or wear and tear on that property. So that's what that depreciation is.
So as opposed to appreciation is the value of the property going up over time, but depreciation is a tax benefit where basically over time the property is worth less in the eyes of the IRS because of wear and tear, like you're saying.
That's right. But I like what you said there, in the eyes of the IRS, right? That property is probably going up in value, but not likely going to be destroyed at the end of 27 and a half years, which is the time period that I can depreciate that property over. All right, and that's when that property has reached basically zero value in the eyes of the IRS over depreciation. But if I've owned a property for 27 and a half years and I've taken care of it, haven't let it go to complete disrepair, I'll bet it's going to go up in value. So this is just a benefit from the tax laws that really adds up and makes a big impact every year on April 15th. And this after-tax benefit, I'll show you how we're going to calculate that based on your investor's tax bracket. The higher your tax bracket, the bigger the benefit is, okay? So hopefully I've explained all four of these quadrants well. Oh, and I forgot to mention on these tax benefits, it does go away after 27 and a half years. That's the time period that you can depreciate a residential property. So is there a
Yeah, and
question?
so
Yeah.
no, there isn't. But I just want to remind all our listeners that if you do have questions, just dive into that question section, into that questions box, type away, and I will interrupt Joe, and we'll dive into your questions.
Yeah, would love to chat about any questions. For whatever reason, I can't see the, oh, I guess it's because I have the PowerPoint up. I can't see the question log. So, Justin, if you see anything pop up there, just jump in and interrupt me so that
Yep,
we can address those.
that's what
All
I'm
right,
here for.
perfect. So, these four quadrants, we're going to combine these and talk about our top two are speculative and uncertain. All right, the appreciation and the cash flow is really going to depend on the market, and it can be volatile, right? This appreciation can go up or down. It can fluctuate on a consistent basis. Cash flow can go up or down, can fluctuate on a consistent basis. Now, we all like to think that every property is going to go up 6% every year, but that's not true. Sometimes properties go up 5%. Sometimes they go down 2%. The next year, maybe it's going to go up 12%. So it's going to vary depending on your specific market. And then cash flow, that's going to vary depending on a lot of things in your market. Don't frequently see rents go down, but it can happen. But generally, we see in tough times in the market, rents are going to stay flat, or you may have to give up some concessions like 1 or 2 months of free rent, which is going to start eating into your expenses. And that's going to eat into some of your cash flow. So definitely harder to predict appreciation and cash flow. Also can appreciation and cash flow can be impacted on what type of property you buy, can be impacted on what type of landlord you are. A lot of people say, well, hey, Joe, appreciation, that's going to be dictated by the market, not by my skill. Well, maybe. What if I buy a property and I'm going to add some value to it? I'm going to clean it up. I buy a distressed property. I'm going to get it into good shape. I'm going to add some square footage. All right. That's going to impact the value of that property. Or on the flip side, what if I leave it in disrepair and I put in a tenant that's just barely cash flowing? Well, that property is not going to appreciate as well as a nicer property. So there are things that you can do to impact the appreciation of your property and also impact the cash flow of the property. If you're putting in nicer fixtures, if you're putting in more square footage or whatever it is you're doing to the home could impact that cash flow. So definitely something that you can really make a direct impact on these two. And generally tends to improve over time. What you'll see with these is appreciation properties generally, air quotes, generally go up in value. Cash flow generally goes up because your mortgage is fixed. That mortgage payment is your biggest expense, and that's going to remain fixed while your income, the rents from the property, are generally going to go up. So that net cash flow that you're going to be getting is generally going to increase and compound over time. Now the bottom side is going to be more fixed and more certain. So this debt reduction does not rely on any market conditions. The tax benefits don't rely on any market conditions. So paying down the debt, even back in 2008, 9, 10, if I had a 30-year fixed rate loan and I was making all of my scheduled payments, even if my value went down in half, if I still continued paying my debts, then that monthly benefit of my debt reduction continued to accrue. Now, if I stopped making my payments, obviously I was no longer getting that benefit. But these two benefits here, the debt pay down and the tax benefits, are independent of the value of the property, independent of the cash flow, but they do still add into this total return on investment that we're getting. And then on the right-hand side is going to be your cash now side. This tends to produce spendable monthly cash flow, all right, which is money coming in every single month. And then your tax benefits is going to be money that you can calculate how much I'm getting, and then you can spend that on a monthly basis and then get your tax return back at the end of the year on April 15th. Or you can use those tax benefits to get a little bit of a larger tax return on April 15th. But I would describe this as cash, or the cash now side that is going to be able to either impact your lifestyle or help you save up to buy another property or help you pay down the debt if you want to. This is cash that you truly can access relatively easily because that money is going to be coming in on a monthly and annual basis.
Hey, Joe, we got a question here.
You bet.
Kevin says, if you hold the rental property in an LLC, do you still see tax benefits?
If you hold the rental property in an LLC, do you still see tax benefits? Now, I'm not a CPA, back to my very first slide, but yes, I hold my rental properties in an LLC, and we do still depreciate them, and we still get the same tax benefits. So I would say yes. I don't see any reason why you would not be able to depreciate a property in an LLC. Justin, what do you think?
I agree. You can depreciate property in an LLC. And so maybe a follow-up or similar question here. Can you wait to depreciate your property tax-wise? Let's say depreciate until after year 5.
I don't know. I suppose you could. I don't know why you would want to, but I suppose you could. You would. That's definitely going to be an accountant question. I would think if you're buying the property now, you would want to take depreciation immediately. I'm not sure why you would want to wait, but I guess that's certainly an accountant question.
Yeah, I agree with that you should definitely be reaching out to a qualified tax professional. Usually investors want to go the other way and
Right.
accelerate the depreciation. So what they'll do is potentially do like a cost segregation where instead of just depreciating the entire asset and everything in and on the property over 27 and a half years, they break out the different parts of the building, like maybe the carpet, maybe the furnace, maybe the roof, and those can be depreciated on an accelerated timetable. So maybe you can, depreciate the roof over 10 years instead of 27 and a half or
That's
whatever
right.
it is. And so you can get bigger tax benefits sooner. But yeah, I'm not sure if you delay it. I think I've heard something along the lines of if you don't use it, you lose it when it comes to depreciation. But I don't know exactly how that works. So that would be a great question for a CPA.
Yep, absolutely. All right. Any others that popped up there?
Nope, we're good for the moment.
All right. So now's the cash later side. This is your appreciation and your debt reduction. All right. This is not something you can access easily, but this is going to be your wealth for the future. This is like the piggy bank that you can kind of tap in later when you sell or refinance. So if you think about these two, if I buy a property for $100,000 down, I buy a property for $100,000 and I put $20,000 down, the difference between these two is my equity. All right. So every month my debt is being paid down a little bit, and every month my property is appreciating a little bit. The difference between those two is that cash later, that when I sell this property, I can get that equity back out, and that would be my profits or my cash later. Or I can refinance and take out a portion of that equity and still maintain the property. So cash later, a little more difficult to tap into, but when I show you guys how these calculations work, this is where you're going to earn a lot of your return, is in this appreciation and debt pay down. So cash now going to be a little bit of a lower dollar amount return, but you can access it immediately. Cash later, a little bit of a higher dollar amount return, but does take time to access it. We're going to combine all 4 of these and you get your return on investment. So it's the sum of all 4 return on investment quadrants is going to be your total return on investment. I'll show you guys how this is going to work. So before I move on here and look at an example property, any questions on any of the 4 quadrants or the total return on investment?
And nothing yet.
Great. Okay. So let's look at a sample property. Now this is a rental property in Denver. And again, I know we got kind of a national audience. So this is a property that I did the financing on. We like to use real transactions. This closed about 2 months ago. This was in Aurora. It's a condo. And this is an analysis spreadsheet that I have. And if you'd like a copy of this, I believe, Justin, do you guys get emails for everyone that logged into the webinar? Is that right?
Yep.
All right, so I'll send a copy of the spreadsheet to Justin, and then Justin's welcome to send it out to everyone. Feel free to use it. What you'll see is everything that's highlighted in yellow are the fields that you can change. So it's built in so that you can't make any errors and change the formulas, but you can put in your own inputs to determine, is this property that you're looking at going to be a good property or bad property. So property was in Aurora, 1 unit property. You can select up to 4 units. This investor put 25% down. Purchase price on the home was $190,000. The acquisition costs, which are your title insurance, homeowners insurance, HOA transfer taxes, any inspections that they got, $2,500 to acquire the property. And the loan costs are calculated automatically on the spreadsheet. We charge a flat $1,540 to process and underwrite the loan. So your total down payment is calculated based on 25% of this 190, $47,500, and a loan balance of $142,500. And then the initial cost to repair the property was $1,000. Very minimal work was needed on this. Very little work, almost a turnkey property. I'm not sure what they had to do. I think they had to clean it and maybe clean the furnace. I don't remember exactly what had to be done, but very minimal. Walking out of the title company with the keys, $52,540 total investment. So this particular loan was at an interest rate of 4.875 for a 30-year fixed, which is astronomically low. As you guys know, rates have been really, really low for investors for primary residence. There's obviously some scenarios where that can be even lower, some scenarios where it's a little bit higher, but this particular investor, that's where it was at, 4.875 for a 30-year term. Monthly income, this property rents for $1,850 a month. There's not a 2, 3, or 4th unit, so it's $1,850 just for that single unit. And then we factor in some vacancy. Right now in the Denver market, vacancy is about 2%. So we included 3% just to be conservative. And then annual appreciation. I mentioned earlier that in the Denver market, properties have been appreciating 6% for the last 40 years. I like to be conservative, and I put in 5% as the annual appreciation. And the effective tax rate. All right, on the actual spreadsheet, if you highlight this little red icon, it'll bring up a helpful tip for you. This is your effective tax rate, not your tax bracket, but how much you actually paid in taxes. So if you made $100,000 and you paid $25,000 in taxes, that would give you an effective tax rate of 25%. So that's really important in calculating your depreciation tax benefits. Then we're going to break down the monthly operating expenses. Do you pay for property management? In this case, it was yes. What's the monthly cost for property management? In this case, was 10%. And how much do they reserve for maintenance? 5%. Now, some properties you're going to need to reserve more. If it's a new property that's in really great shape, maybe it's a condo like this that doesn't have a lot of work that's going to need to be done to it, you can reserve maybe less. Maybe it's a property that was built in 1921, bungalow with, aluminum wiring and old mechanical systems. You might need to reserve 8, 10, 12% to maintain that property on an annual basis. Then there's a homeowners association. In this case, yes, and the monthly HOA dues were $299 per month. Then we get into the annual expenses. The only additional annual expenses that this property had were taxes of $958 and property insurance of $300. Any questions on what we've calculated here? And Justin, let me put you on the spot. Did I leave anything out on any expenses that you would recommend?
No, that feels pretty comprehensive.
Okay.
Almost actually feels a bit overwhelming, but this is not just we went into some guru handbook to figure all this stuff out. Like, this is you and me and Chris actually doing deals, and these are the costs that we're up against in our own properties. So
That's
yeah,
right.
it does feel very accurate.
Yep.
Now here's a question. Before we click to the next one, how can we calculate property insurance?
Okay, it's going to be tough to calculate. What you're going to want to do is just reach out to your insurance rep. I use Liberty Mutual, have a great guy over there. And I just call him and say, hey, you know what? I have this property in Aurora, 123 Main Street, looking at purchasing it for $190,000. Please give me an insurance quote. And then he'll say, hey, it's $297. Great. Or he'll say it's $182. Great. So you will have to actually talk to your insurance guy, or after you've done a number of these and filled out the spreadsheet a number of times, you'll start to get kind of a feel for it. So in this case, it's a condo. I know that this is just an interior unit. I think my insurance guy would be right around $220 for the year. Um, I did the financing for this transaction. This was not my own personal purchase. And the $300, that is the actual insurance that this individual paid. So that's going to vary depending on your coverage, all sorts of different stuff. So I would say as you do more of these, you'll kind of just get a feel for what number to plug in there.
Yeah, and again, this is a condo, and so an annual property insurance is $300. Where if it's a single family or a duplex or something like that, safe to say that that insurance would be higher. But again, that's why Joe's saying to reach out, talk to the professionals, and just get a quote.
Yep, absolutely.
I
Absolutely.
got another question. What
Okay.
about PMI? First
All
off, what
right.
is PMI? And then their question is it necessary?
So PMI is private mortgage insurance when you are putting down less than 20% on a property. So if you're putting down less than 20%, the lender is going to require that you have mortgage insurance to insure them against any potential loss. In this case, we put down 25%, so no, there is no mortgage insurance required. However, the spreadsheet will calculate it for you. If you put in there that you're putting down, let's say 15% minimum down payment for a rental, it will calculate that monthly mortgage insurance for you. So pretty slick system that'll do that.
Gotcha. And so that in the lower right corner of the property insurance is not PMI mortgage insurance. That is just like a landlord policy.
Yeah, this is like wind, hail, theft, damage, anything truly insuring the property, not insuring the lender.
Gotcha.
Okay.
Another question here. Is this assuming the tenant is paying all operating expenses?
I would not say all operating expenses. The tenant's certainly paying utilities, but I would consider, property management to be an operating expense. I would also consider the HOA to be an operating expense. So really, the tenant is going to simply be paying the utilities. I believe is heat included over there? Heat might be included in this property, but I know water is not. So the tenant would certainly be paying electric, water, heat if that's appropriate, if it has natural gas, and then if they've obviously got to pay their own internet, cable, etc.
And so the distinction there would be the tenant pays $1,850 a month to the property manager, and then they have a different bill that they pay for the water and a different bill for the electricity or something like that, as opposed to some of these other like HOA expenses. The tenant does not cut the check for the $299. That's going to be the investor or the property manager who pays that.
That's exactly right. Yep.
Gotcha. One last question right now before we maybe move forward. So if you're renting the property, don't you need a different type of home insurance?
You do. You need to have a landlord policy. So when you contact your insurance rep, you're going to say, hey, you know what? This is not a property I'm going to live in. This is a property that I'm going to be renting out. So please, give me a quote for a landlord insurance policy. And they're going to have some questions, right? They're going to ask you, hey, you know what? Do you want rent loss coverage? Do you want coverage for the tenant's possessions? In my case, I say no. They've got to have their own renter's insurance. I'm not covering their possessions, but I do want at least enough coverage to cover the cabinets and the carpet and the floor coverings, etc. So it is a different policy than your personal home. My personal home, it covers the house and all the possessions inside: the couch, the stereo, the TV, etc.
Yeah, exactly. And then so I know we're not talking about fix and flips, but since so many of the folks that join us on these webinars do fix and flips, a fix and flip would be a different policy altogether. So it's not a homeowner's policy, which is where you live in the house. It's not a landlord policy where you have a tenant living in a house. A fix and flip, we would want a vacant policy since nobody lives in the house. So of
That's right.
course, with nobody living there, risk is higher. So the costs are usually higher, but they cover more things. Specifically associated with vacant properties. So definitely, if you're not very familiar, if you're newer to investing, reach out to a couple different insurance agents and just get a feel for what they offer and ask questions. And of course, always reach out to Joe and I. If you don't feel like you're getting the right answers from your insurance agent, and we're happy to help point you in the right direction based on our experiences.
Yeah, I have some great insurance guys. Obviously, they're here in Denver, but they're terrific. I mean, I have guys that have done hundreds of policies for my clients, and they know how to work with investors.
All
Okay.
right, Joe, keep
Any
going. What do
others?
we got? We're
Okay,
good for the
great.
moment.
So with all that information input, the next page of the spreadsheet is going to give you your net operating income. So this is really simple. I'm going to flip back and forth here a little bit. This is your monthly rental income times 12 months minus my monthly expenses and my annual expenses to give me my net operating income on an annual basis. And it does factor in the mortgage, factors in that principal and interest payment, which is going to be about $9,000 a year, $754 a month, for an annual cash flow of $4,309. Now, the spreadsheet's also going to give you some results. The first one is going to be your cash on cash return. So the cash I'm getting out of this property, $4,309 per year, and I invested $52,540. So I'm going to flip back one screen here. $52,540 was the true cash that I put into the property. $52,540 is that number right there. $4,309 is the true cash that I'm getting out of the property. That is an 8.2% return for my cash flow. That's my cash on cash return. And then I like to also measure the cap rate. So the cap rate is the net operating income. So this is a way that Justin and I, two different investors, might compare one property, because cash on cash is subject to the financing costs, where the cap rate, maybe Justin wants to put down 50%, maybe I want to put down 25%. We're going to get different cash on cash returns, but the cap rate is going to be independent of the financing. So the cap rate is simply that net operating income divided by the purchase price and repairs of the property, so that new value of the property. So $13,358 divided into that $191,000 value, that's a 7% cap rate, all right? Justin, do you think that's a pretty good deal? A seven cap with management?
Yeah, that is pretty good.
It is pretty good. But you know what? We hear a lot in Denver, and I'm sure other markets hear it. Oh, there's no deals out there anymore. There's nothing left to buy. Investors have missed the boat. I would buy this deal all day long. And this was on the MLS, available for anyone to purchase. And then my last metric that I really like to look at on this slide is the gross rent multiplier. So the value of that property after repair is $191,000. Divided by the rents on the property, the gross rents of $1,850, that's a 103.2 GRM. So the lower this GRM, the better. All right, so the lower the better. A lot of people like to use the 1% rule. That's a real popular one that I see on internet forums. Very difficult to find properties that are going to meet the 1% rule, meaning a $191,000 property is going to rent for $1,910. Very difficult to find those in Denver, but if you do, definitely take a look at it. Anymore, we see average GRMs are 120 to 140, and those can still be a very good return depending on the expenses. All right.
Yes, exactly.
Yeah,
And so to calculate the 1% rule, you would just take those two numbers, the 191,000 divided by 1,850 in rent, and just flip them. So you would take the $1,850, divide that by the 191,000. And so in this case, that would be like, instead of 1%, it would be like a 0.97%. So
Yep.
this property is very, very, very close, basically is 1%. So
That's right.
killer deal.
Now, let me ask you this, Justin. Maybe we'll take a poll. This is a 7 cap. What do you think the return on investment is for this property? Percentage.
Ooh, so like diving into your the full cash flow ROI quadrant here, the full
Yep.
calculated,
So we have 8.2 in this cash flow quadrant here. What do you
right?
think is our total ROI?
Definitely higher.
Definitely higher. I agree with that. Give me a number.
I don't really know. I'll say 15.
15. Okay. Would you buy a 15% ROI?
Yeah, yes.
Okay. Listeners out there, I want you to type a yes if you would buy a 15% ROI. And think about this. You probably don't get 15% in your 401k. You probably don't get 15% in your IRA. I know I certainly don't get 15% in my savings account over at US Bank. All right. But if I could show you how to get a 15% return, would that be appealing? I think most people are going to say yes. All right. Well, let's see what we get here when we look at the ROI on this.
And I'm interested to hear who would say no, because we definitely have a lot of people saying yes, some a yes with an exclamation point, 100%. Oh, somebody says they're betting it's over 20%.
Okay. I like that.
So yes, people are excited and would move on a 15% ROI. So let's see where we're at, Joe.
All right. So 7 cap, 8.2 cash on cash. This is a 33.2% ROI. Let's walk through these numbers while everybody is shocked and sending like the oh my God emoji face. All right. Our cash flow, 8.2%. So over here on the left, this is the percentage cash flow. Over here on the, or pardon me, the percentage ROIQ. Over here on the right is the dollar amount ROIQ. So I included this so you can see the actual equation that makes this up. So cash flow, $4,309. I'm going to flip back and forth here. 4,309 is our cash flow on our cash investment of 52,540. That is an 8.2% cash flow, cash on cash return. Now the property is appreciating $9,500. Now Justin, $9,500 was our 5% appreciation percentage that we put in, but this is showing an 18% return on my investment. Why is that?
Because we're comparing it to the cash out of pocket.
That's exactly right. So I invested $52,000, $52,540 is my total investment, and that gave me a return in year one of appreciation of $9,500. That's an 18% return right there just on the appreciation. All right, now let's keep in mind, both of these are speculative. All right, speculative and uncertain. Let's look down here at more speculative and certain. Debt pay down. This debt, the tenant made his payment to me every month, and I made my payment to the mortgage company. My debt went down by $2,150. And then I was able to depreciate the property and get some tax benefits of $1,468. That's a 4.1% benefit in debt pay down, a 2.8% benefit in depreciation. Let's add these two together. This is 6.9% return, nearly guaranteed. Justin, if I told you I could give you a 7% guaranteed return, would you be interested?
I would be.
And it's right here, all right? Now, we had a lot of people that say, yes, I would do this for 15%. What do you guys know? And we did have one person who guessed greater than 20, 33% return, guys. And this is where we talk about in past years, we focused so much on cash flow. Oh, I got to have a 10% cash on cash, 15%, 20%. And people were buying those and they were making a lot of money. And they were still making money on the appreciation. They were still making money on the debt reduction. They were still making money on the depreciation. What we didn't have was a quantitative way to measure it. And now we do. And this becomes very, very powerful if you think about, I could invest $52,000 and make $17,000 in the first year. That's a 33% return on my money. Now, there's some catches. This is liquid. I get about a 11% liquid return, all right, 8.2 plus 2.8, an 11% liquid return, and like a 22.2% non-liquid return. I've got to sell the property or take a loan out to capitalize on this. Either way, these are real dollars that I have earned with this investment. What questions are in the chat box now? Does this make sense?
Yeah, I just have someone saying awesome. So
Yeah.
I think they're seeing the power. I mean, first of all, this really just comes back to the power of investing in real estate, right? It's not just the cash on cash return. It's not just the monthly cash flow. It's all these ancillary benefits to investing in real estate.
That's exactly right. That's exactly right. All
All
right.
right, so I do
So,
have one question here.
yeah.
Let's see if I can read this whole thing. Question on principal paydown strategy. Without looking at net cash flow, does it make more sense to go 15-year fixed on some of my larger balance properties in my portfolio for larger forced monthly principal paydown?
Okay. I think that's a super fair question. I can answer that. I'm going to use this example. Let's just say that I did a 15-year loan and the additional payment, the additional debt reduction is $4,309. So what you would see is this $2,150 here for debt pay down would be, what would that be? $6,459. So now I'd be getting a 12.3% debt pay down return. My cash flow would be $0 and my cash flow percentage would be $0. But what do you know? My dollar return on investment would be the same. My percentage return on investment would be the same. So one of the things I like about this is these two are connected. And so you as the investor can decide, hey, maybe I don't need $4,300 in cash flow right now. I'll give you guys a good example. Hey, I have a job, and the majority of my income comes from my job here as a mortgage lender. So this $4,300 a month would not make a huge, pardon me, $4,300 a year would not make a huge impact on my life right now. So I 100% agree with that I would take this $4,300 and apply it to the debt, because I'm not in a position that I'm ready to live on that cash flow. I would be using that cash flow to pay down the debt. But keep in mind, my percentage and my returns don't change. It's just how it's been allocated to the various quadrants. So I hope I've answered that question, but I think that's certainly a good strategy if it makes sense for you.
Awesome.
Others?
Yes. Can you calculate the best time to sell based on ROI?
I would say probably no, because you don't really necessarily know how to time the market, and you don't necessarily know what's going to happen in the long term. I don't know that you're going to want to sell the property in 2025, right? So this is really just based on buying the property, holding it for a long term. At some point you want to sell it, fantastic, sell it, and then you're going to be able to capitalize on this cash later. So I think I don't know. Maybe I think let me rethink about that question. In the future, this debt pay down is not going to be as much. Maybe in the future, the market has flattened and I update my spreadsheet every year with the new year's numbers, and I'm not getting as much in year 6 or 8 or 10. Yeah, maybe it would make sense to sell it. I think it would take a little more manual work than just simply plugging it in on day one and it's going to tell you this is the time to sell. But I certainly think I know that I do this, and I imagine Justin does this, that I update my spreadsheets for every property every year, and I review, does it make sense to sell or does it make sense to keep it? So yeah, I think you could use this. You would just need to do a little additional calculating on it every year.
Yeah, and I like where you're going with that, with the debt pay down slowing down, the appreciation may have flattened or cash flow may have flattened, at least, year over year growth, depending on what's going on out there in the markets. Depreciation, especially if you try doing a cost segregation, you maximized it up front, and now maybe you're in year 10, and so the depreciation slows down. So lots of variables, probably not too big depending on the market, in the first couple years. But then again, it also depends on your strategy. My strategy right now in regards to my rentals is just hold them forever, pay them off and just keep them cash flowing. And then who knows, maybe, leave them to my kids eventually if they're interested or if I still
That's
love
right.
them. But,
Hopefully, hopefully.
um, but yeah, so I mean, I think, yes, you can use it to help influence your decision, but it also very much depends on your strategy.
Yep. Now, another point I like to bring up, a lot of people say, well, hey, this appreciation, 18% return on my money and appreciation, that's just too high. All right. Now, this is based on only the property appreciating at 5%. All right. Now, maybe Justin pointed out, we've got a national audience. Maybe 5% appreciation is not realistic for your market. Let's change it to 3%. So we're going to change this field. Let me go back here, right here, this field right here of total annual appreciation from 5%. We're going to change that to 3%. And what do we get? The property still appreciates $5,700. We still have a 10% return on appreciation for a 25.9% return on investment. I still think that's a pretty darn good deal. What do you think, Justin?
Yeah, absolutely. I mean, and the market changes. So I think on that first page when we're putting in that placeholder there, we're just kind of plugging something in for the long haul, right? We're not necessarily going in and changing it each and every year. I suppose you could, and like print it and save this spreadsheet, each year, something like that.
Mm-hmm.
But yeah, that's certainly something interesting. And depending on your market, plug in things accordingly. Now,
Yep.
there's another question in a similar regard. How would the numbers change with a lower down payment?
Okay, that's good. Really good question. So we're going to look at another scenario. We're going to talk about that. So this is a client. If you're familiar with the nomad strategy, which that means moving in, buying a property as a primary residence, living in it for a year, 2 years, and then moving out of the property and renting it out. All right, and now creating it using it as a rental. So this is a property in Arvada, 5% down payment because they're living there. This is their primary residence. Purchase price on the home was $430,000. Now the spreadsheet's designed to calculate investment property loan costs, not necessarily primary residence. So when you plug in a really low down payment, it kind of gives you some weird answers on your loan costs. So we had to put in here a negative for acquisition costs because their actual closing costs were about $4,500. So if you combine these two, it was $4,500 in total closing costs. Down payment of $21,000, which is 5%. New loan of $408,000. This was a turnkey property, needed no initial repairs, $26,000 initial investment. 3.75% interest rate on a 30-year loan. Now 3.75 because this is a primary residence. Now this property, once they move out, they're going to rent it out for $2,500 a month. 3% vacancy, 5% appreciation, 25% effective tax, yes, 10% property management, reserves, no HOA. You do have taxes, you do have insurance, and the owner is paying $1,500 for water and sewer. All right, so that is not going to be put in the name of the tenant. That is going to be held in the name of the owner. So there was a question earlier about who pays those expenses. In this case, the tenant would only be paying the electric and gas. The owner of the property is paying the water and sewer, or the landlord. Let's see what results we get. Net operating income of $20,000, monthly mortgage payments, and then there's a star here that the spreadsheet will calculate your estimated mortgage insurance for you, roughly $146 a month. Now, a lot of people automatically panic, oh my God, I want to avoid mortgage insurance. I don't want to do that. Terrible deal. Stick with me for a minute here. Let's see if this is still a good deal or not. Now, this property is losing money. It's losing $4,458. So the cash on cash return is a negative 17%, losing $4,400 on an investment of $26,000. Cap rate 4.7%. So it's a $20,000 net operating income on a $430,000 property. 172 GRM, so $430,000 property divided by 2,500, 172. Justin, what did I say about GRMs earlier? Lower is better, right?
Correct.
This is not nearly as low as that 103 we looked at on the last one. Do you think this is going to be a good deal or a bad deal for our return on investment quadrant, Justin?
Well, right now, I'm not a big fan of it.
Not a great deal. Losing money cash on cash, low cap rate, crappy GRM. Losing money on our cash flow. So we have a negative 17% cash flow. However, this property is appreciating $21,000 because it went up 5%. Now we only invested $26,000. So right out of the gate, we get an 82% return on our appreciation. The debt paid down $7,500. We depreciated the property $3,300. That's a 28% and a 12% return. So my guaranteed return is over 40%. Now, total cash return, $27,876, or 107.2%, because I only invested $26,000 and it's returning me $27,000 in the first year. You think this is a good deal or bad deal, Justin?
I'm going to go with the safe answer of it depends.
There you go. This is not necessarily a great deal if I'm looking for cash flow, not necessarily a terrible deal if I'm looking for appreciation, not necessarily a deal that everyone should do, not necessarily a deal that everyone shouldn't do. There's some catches, right? I've got to put money in to support the cash flow and support the ownership of this property. So I'm losing 17% here, but a big portion of that is being gained through debt reduction. Okay, so these two are tied together. So I do have to subsidize this property in order to get the returns in these three quadrants and ultimately my total return. So I'm basically continuing to put $4,400 each year into this property. I would describe that as deferred down payment. I put down $26,000 on day one. Now I've got to be putting in another $4,400. So I'm putting in $30,400 after day one and into my first, or I guess would be my second year once this property is rented out. The next year I'm gonna have to invest more money into it, but I'm getting a big return in these other areas. So the question earlier was, what happens if you put less money down? You get a much higher return, but remember from real early on in the presentation, lower down payment eats up into that cash flow.
Yeah, so the overall ROI skyrockets, but depending on what's most important to you today, that cash flow was actually negative. So really interesting to compare these. This is fascinating to me. So I appreciate. I'm really interested in playing along and playing with this spreadsheet when you
Yeah,
send it over. Now,
yeah.
Chris has a question. He says it seems risky if you can afford it. The unknown is, will the market be as robust at the time you want to sell? Is that statement correct?
Absolutely. The top, that's absolutely correct. This top is speculative and uncertain. Absolutely. The bottom section is more certain and nearly guaranteed. If you're counting on this quadrant, yes, you are absolutely speculating. So you need to make a decision about what's most important for you and your investment criteria. This is absolutely speculative, and there's a lot of leverage on this investor because he didn't put a lot of money down. It does not take but just a small change in the market for this client to be upside down. All right. So, absolutely, I think this is very speculative, which is why I always recommend more money down. But I want to be clear, putting more money down yields a lower return on a percentage basis. So, you guys out there, the investors, you need to think about what's the trade off that I want? Do I want more safety, or am I comfortable with more risk to get a better return? So, definitely a great question.
Yeah, absolutely. And you got to be thinking about, what's your what's the time horizon on this? If you're looking 5 years out or less, or maybe even potentially 10 years out or less with that little down payment, potentially there's some risk in there because the market can fluctuate and can really affect the appreciation, the short term, benefits there. But if your time horizon is much longer, then this could be a great strategy, or at least something to maybe add in. So certainly something to think about. It's got my mind thinking uh, and running in several different directions already.
Yeah. So what I've gone on my next slide, I know we're short on time here. This is just a comparison between the two. So this is a property with lower money down because we're going to live in the property for a year. This is a property that's an outright investment property right out of the gates. What if we were to combine these two? All right. What if I put a big down payment here? What if I did a minor down payment here? And then after living here for a year, moved out, moved in with, I don't know, my girlfriend, my spouse, my whatever. And now I've got these two rental properties. This cash flow here could be used to support the majority of this property. And now I have two properties cash flowing and appreciating, right? So you can kind of combine these and these can cross over from one quadrant to another that, hey, I'm getting this return, this cash now, and I can use it to pay this cash need right now. So think about how your various properties might tie in together.
Yeah,
We're getting
absolutely. It's an interesting way to kind of look at the overall portfolio that you're trying to build.
yeah.
Now you were talking about potentially a lower down payment. As an investor, can they get a loan with less than 20% down?
Yep, we'll help you with a minimum of 15% down for a non-owner occupied or investment property. What other questions?
Well, there is a comment that these are nearly identical to Tyler's two current properties, so he's pretty excited about taking a look at this.
Oh, really?
Um, now, if we have an investor taking out a mortgage and there's only 15% down, does that then trigger mortgage insurance?
Yes, it does.
And what states can you lend in?
I lend in Colorado. So unfortunately, I don't do any lending outside of our local area here. But if you do have a need in a different area, let me know. We have a very large branch network. We're licensed in about 33 different states. I could connect you with one of our local locations there. And also, one of my close colleagues works at a company that's licensed in all 50 states. And I can connect you with him if it's not a state that we lend in.
Do you lend to an LLC?
No, unfortunately, we don't do any commercial financing. Everything that we do is going to be for individuals in your personal name.
And do you offer non-recourse loans for investments within,
No,
say, retirement or qualified accounts?
no, unfortunately not. Kind of same thing. We don't do any non-recourse or any sort of commercial financing. Everything would need to be in your personal name, but certainly a good question. Certainly a good option out there. I know there's a lot of great lenders that do that.
Yeah, and so typically if you're looking for like a non-recourse or you want to just lend directly to your LLC, a commercial loan, like Joe's saying, then maybe be reaching out to your local banks.
Yep.
And try and build that relationship with them, and they might be able to help and be that better fit for that type.
Yep.
Here's
Absolutely.
another one. I have an option to buy my interest rate down to almost 0% on a 15-year loan. Do you have any spreadsheet to calculate if it's worth buying it down versus a bigger down payment versus not using the extra money at all?
Um, No, but I think that's pretty easy to calculate. If you're going to buy it down to nearly 0%, you're going to be spending a large amount of money. So I would just calculate what is your payment difference. If you spend $5,000 or $10,000 to buy it down, and that's going to save you $100 a month, I would take that $10,000 divided by 100 months, or pardon me, $10,000 divided by $100. It's going to take you 100 months to pay that off. Do you plan to keep the property for at least 100 months? If so, then it would potentially make sense to do that. If you're planning to sell the property before that point, it would potentially not make sense to do that.
Gotcha.
Yeah.
And then, so Mark is wondering if you can share connections in some specific markets. So Mark, probably because Joe would have to open up other screens and put us all on hold, I think it'd probably be best if you just reach out directly to Joe if you're looking
Yep.
for some referrals. But Joe definitely has connections across the country, so definitely reach out to him directly on that. Jane says, I write the loan in my personal name, then quit claim to an LLC.
Yeah, I think we actually have a slide for that. So we'll skip over the higher end properties. Let's see here. There is it in here? It's not on here. There is a slide you can find at, let me pull it up here. I think I've got it saved on my website. So bear with me just a second here, guys. Uh,
And you're looking for a slide that has to do with getting a loan in your personal name and then quit claiming it to an LLC?
yeah, I've got we recorded an entire podcast on that. I've got to find it. It's a great question. And we actually had one of our attorneys record a podcast with us on that. And I just want to find the link. I'll share it for you guys because it's definitely something that you can look at. But go ahead. What other questions do you have while I'm looking for that?
The one other question I noticed was that it looks like the website on the lower part of the screen didn't work for someone. So I think that's at realestateFinancialPlanner.com. They were having trouble pulling that up.
Okay,
So that's more of an FYI for us, I guess.
good to know. All right, yeah, I'll definitely check that out.
Now, that's a
Um,
pretty long website. So, to whoever had issues with that, first and foremost, I would double check that you spelled everything correctly. But secondly, yes, Joe and I can definitely discuss that offline and
yeah, we'll
make
take a
sure
look
that
at
we
that.
get something squared away on that.
Bear with me, guys. I know I have a link for purchasing in an LLC or purchasing in your primary resident or in your personal name and then transferring it to an LLC. I'm just going to find it here. What other questions?
Can you explain the effective tax rate a bit more?
Sure. The effective tax rate is how much you pay in taxes as compared to how much you have in income. So, the easiest way to describe that, I'm going to pause the webinar here for a second while I find this link. The easiest way to describe that is if you make $100,000 a year and you pay $25,000 in taxes, then your effective tax rate is 25%. So that's the way you should always look at that. It may not be that you're in a 25% tax bracket. It may simply be that you're in a 30% tax bracket, but after your deductions and expenses and whatnot, you can work your taxes down to a lower level so that you're not having to pay so much in taxes. I did find that link here. Sorry about the delay here. It is very complicated and hard to see, I'm sure. DenverInvestmentRealestate.com/LLC. DenverInvestmentRealestate.com/LLC. And you guys can go on there and listen to the podcast about purchasing a property in your personal name and then transferring it to an LLC.
Awesome, Joe. Awesome. Well, I think that's all the questions we have. Joe, do you have like one last slide maybe with your contact info? just in
I
case?
do. Yep. Here's all my contact information here. Jay Massey at Castle Cook Mortgage. You can reach me at loansbyjoemassey.com. And then, of course, Chris Lopez, DenverInvestmentRealEstate.com, put this together with me. And Justin, I'll send you a copy of the spreadsheet that you're happy to send that out. In fact, I'll send you this link for the LLC podcast. If anybody would like to listen to that as well, you're welcome to check that out. And any final questions that I can answer?
As we wait and see, of course, my email address is justin@pinefinancialgroup.com. So this is being recorded, and so anybody who's watching this on YouTube, feel free and reach out to any of the three of us. Always happy to help and dive in and make sure that we can get you the spreadsheet that we've been talking about. So again, mine is justin@pinefinancialgroup.com. I am a hard money lender, and so if you're looking to be doing fix and flips or buying one of these rental properties with that needs more repairs, and you want to buy it with hard money, fix it up using the hard money, and then refinance. Obviously, those numbers will be a little different than what we talked about, but using hard money from Pine Financial Group and then refinancing it into Joe's loan is an amazing strategy as well. Looks like Miles says, are there buy down options right now to get close to 0%?
On a 15-year loan, probably not. On a 30-year loan, definitely not. But you know, I joke with a lot of our clients that 0% is always available. You just simply pay cash for the property. That's how you would achieve a 0% interest rate.
Gotcha. And so Castle and Cooke, are you guys a portfolio lender?
We are, yes. We keep the majority of our loans in our own portfolio.
Awesome. And so that is the last question. Going once. Oh, any examples of bad deals? Kevin, I think we could go on for hours about
I have
bad
millions
deals.
of those. Yeah. Yeah, I mean,
Just
we
in
see
our own
people.
portfolios.
Yeah, well, I don't have any bad deals. I like everything I have. But there's millions of deals out there. I mean, I see people. I met with a gentleman today who's, you guys know this is a great time in the real estate market. Every property has equity. Every property is cash flowing. This gentleman has a ton of equity in his home, in his investment property, and has managed to run up a lot of credit card debt to build up that property. And unfortunately, he's at a position that he cannot qualify for a loan to pay off that credit card debt. And I recommended that he probably needs to sell it. And he just says, well, I'm keeping this property for my future, for my kids. And you know what? I get that. But unfortunately, that property is not cash flowing right now. And unfortunately, he's not able to make the payments. If he doesn't sell it, he's going to probably have that property foreclosed on in the future. So bad deals, I would say be aware of what you're getting into. And if you get into a bad deal, sell it. Don't just get stuck on, oh, it's got so much equity and it's going to be so great in the future. Yeah, that's true, but you still have a lot of debt somewhere else. So that's an example that I experienced today. So there are people, not always doing great in real estate. It is easy when we're here on the webinar to talk about the great deals, but there's a lot of bad deals out there too, and I often see that as a result of an issue that with the investor, or maybe they made some mistakes. And Justin, I know we spoke about it on my show earlier today. You had some struggles in your very first deal, and I was kidding. I've had struggles as well. I think you just have to understand where you're at and know when to cut bait.
Yeah, absolutely. I mean, one of the most important things is just because there are so many moving parts when it comes to investing in real estate, having a massive investment, hundreds of thousands of dollars at risk in one way or another, somebody else living in this property, that could not take care of it, and to get it back to a good state could cost so much money. Probably the best way to safeguard yourself is to just have some money available. Um, it's a strategy you can use to put little to no money down, but that doesn't mean you should have little to no money. Or if you have a lot of money, doesn't necessarily mean you should put all of it down on a deal to kind of increase your monthly cash flow or anything. You really got to make sure you're ready for the dips and changes and random tenants that don't respect your house and lots of other things. And so it's always a good idea to have a good little cushion of cash on hand, whether the tenant leaves in the middle of the night and you need to make that next monthly payment yourself without the support of a tenant paying rent, you need to fix up the property, both. It's always good to have a couple bucks on hand to make sure you can get through whatever storms will come, because it's not an if, but a when.
Yep, I agree.
Maybe one last question here. What is house hacking?
Sure. House hacking is simply buying a property that you're going to live in as your primary residence and then renting out other portions of the home. Very common to use with a duplex where, I'm going to live in one unit, rent out the other side. Or maybe I'm a single person and I buy a 3 or 4 bedroom home and I rent out the other bedrooms. Done appropriately, you can have your mortgage completely paid for and you live basically rent free. You combine that with purchasing a property every 1, 2, or 3 years and moving into it, continuing to rent out that other space. It's a very, very easy way to gain wealth. There's some headaches with it. You got to move a lot and you have to have roommates, but it can be a great strategy to gain wealth in the long term.
Yeah, absolutely. I agree. All right. Well, it looks like we have run out of questions. So thank you to everybody for sticking around, asking such great questions. Feel free to reach out directly to me. Again, Justin at pinefinancialgroup.com, and we will get you this spreadsheet. Joe, appreciate your time coming on this evening, sharing your spreadsheet and your new class. I'm really excited to dive into this with this next property I'm actually under contract on right now.
Hey, thanks so much, Justin. Really appreciate the time. Really appreciate everybody being on the call. If I can do anything else, always feel free to reach out.
Yeah, and for those again in Colorado, please check out denveriss.com coming up on October 12th. We'd love to see you there. Thanks, everyone. We'll see you next month on the webinar.